A common financial mistake we see some people make is spending more money than what they have coming in each month. So they're spending at a deficit, maybe running on credit cards or personal loans. And so just a good way to start getting out of that is understanding your budget and where's my money going? Maybe what are some expenses that I can trim down to not be spending at a deficit? And then once you are breaking even or have a little bit of excess money each month, then you can start looking at, okay, where does this excess money need to go? Does it need to be paying down credit card debt, student loans, personal debt, mortgage, or can I start flowing this into more personal goals, retirement, short-term goals like travel, house down payment, anything like that. Something we come across with some clients is having inactive cash or cash not working for you. So having cash isn't always a bad thing, but having cash that is just sitting there not earning you free interest is working really against you. So right now, money market funds are earning anywhere between 4 to 5%. And so if you have an emergency fund or a short-term savings goal that's parked in a checking account, not earning anything, you're losing really a risk-free return on that cash. That's basically free money. So every dollar that you have that's sitting in cash should theoretically have a place to live. So you don't want to be sitting on too much cash. Maybe you have your emergency fund, maybe you have a travel bucket, a down payment bucket, other savings buckets, but every dollar that you save or that you're holding on to should have a place to live. One mistake that we see is employees not understanding all of their employer benefits. And so you may be leaving free money on the table. So one way that we see this is not getting the full retirement match that your company offers. So if they offer a 4% match and you're putting in 2%, you're leaving 2% of the company's free money on the table. So let's take advantage of that. Let's max that out if cash flow allows. But then let's also look at other benefits. Maybe you have multiple accounts that are living at different custodians that can be consolidated into one. That's just going to simplify your financial picture, but then also help you track down everything that's out there. But then also looking at how do all these accounts work together and what's my overall investment picture look like. You don't want to have two accounts being invested differently without knowing, okay, what's my overall investment picture? How are all these accounts working together and helping me over the short term or long term? One area that we help clients a lot in is helping them finish and even get started on their estate documents. So whether that's going to an attorney or using a service that we have complimentary to clients of wealth.com, it's getting all the right documents in place so that you know that your money is being taken care of, whether something happens to you or your significant other. But then also, even a low-hanging fruit is taking care of beneficiaries on all your retirement accounts. So just naming who does the money go to as my primary beneficiary and even listing contingent beneficiaries is something that can be knocked out very quickly, but has such a huge financial impact in just giving you peace of mind knowing that that's taken care of. Not getting invested or saving early in your career. So whether that's starting small and saving 2% of your salary or 5% of your salary, those small savings can add up over the life of your career because of compound interest. But you're also starting the habit of saving, you're automating those savings, you're not seeing the money come into your checking account. And then also taking it a step further is once you start saving at an early age, maybe when you get a raise or you see a bonus, you start putting those savings into your retirement account or other short-term goals and just getting in the habit of starting young so that you have compound interest over 20 to 30 years and you're going to see a lot of growth. Once you fund your Roth IRA for the year, maybe you're maxing it out, which is great. You also have to take the next step in making sure it's invested correctly. So just because you fund the Roth IRA or traditional IRA, it doesn't necessarily mean that it's being invested in the market. So just taking a step and looking at, okay, how do I want these funds to be invested aggressively or not aggressively, depending on your goals. When the market becomes volatile, sometimes we see people and clients wanting to go to cash. So going from the stocks or bonds that they owned to cash because it feels a little bit more safe. A lot of times it can do more damage because, yeah, you may time the market right to avoid the crash or the downturn, but you've also got to time it on when do I get back in on when I think the market's going to recover. And so a lot of times that can cause more harm than good to your portfolio. And so just having an investment plan that works with you and you can go through the volatility and rebalance during those times or add more cash to buy stocks when stocks are down is very powerful. And I think that's where partnering with an advisor has a lot of value, because we can work with you and determine how aggressive do you need to be in these accounts, and are you able to withstand a 15, 20, 30% stock market decline, make it through that, and then see the appreciation after that as well. A lot of times people just think of an HSA as taking care of your medical expenses, which it can be used for that, but if using your HSA to its full potential, we really like to think of it as like a supercharged Roth IRA. There's 3 big tax benefits with the HSA. So when you put contributions in, you get the tax deduction for the year on your income, you get tax-free growth on an HSA if it's being invested, and then you can reimburse yourself for medical expenses, and that money comes out tax-free to you. So what we tell our clients is, if you're able to cover medical expenses through your cash flow, pay those out of pocket, save the medical receipts over the years, and 10 years down the road after you've invested the HSA, maybe it's worth $20,000 and you need to pull money out, you can submit previous medical receipts and reimburse yourself for that.